Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to Cycles TV pre-Christmas episode. Almost 1 week to go. Then Santa Claus cycle, the seasonal cycle of Christmas is arriving. Thanks for joining the Foundation for the Study of Cycles. My name is Lars. Today we do a cycle analysis with the special focus on the markets are so nice. So we need to do an update on the stock market cycles, and specifically I want to reveal with you some projections we did in October and November based on Apple as a proxy for the tech sector. So let's review that, because that's so important what happens these days, that we want to learn from current behavior of cycles. It's just the first 5 minutes. Second, and this was proposed during the last weeks, let's check the US dollar index. Let's have a view at Forex cycles, and we will use the US dollar index as a proxy, and then we will have a special look at the euro versus the US dollar, just vice versa from one Forex pair. That's it for today's 20 minutes to 30 minutes to run. We are live, so I'm happy to take your questions during the session, or at least at the end. I will pay attention to the chat section. If you have any questions, feel free to drop it there. Let's start with a current review of our past projections we did on the stock market. So therefore, I want to select the Apple proxy chart we used several times. And if you just go back to this analysis we did back in, you see the live here, end of October. We did a stock market update on cycles, and I used Apple as a proxy to explain the change of cycles and the dynamics, and I did an update. And it's so fascinating how this played out, and it's also a lesson where we can learn from how to play cycle analysis. You can go back to the October session on your own to review the full session. I want to start with the focus on what was the projection there. And if maybe you remember that session, this was the analysis we did, and I will make it even a little bit larger. So here's the projection we exactly did in the live call. You see it here on YouTube on that day. And you can see here, it was this was the day we did this analysis here in late. Let me just assign it. Why can't I find it? Somehow not working. Okay, let's close this one here. I want to close it. Oh my God, give me a sec. Sorry, now it's gone, right? So this was the end of October analysis, and we had a 3-cycle model, a model based on 3 composites here. And we used this, I think, from early October, if not September, the first time. And the first model based on these 3 cycles proposed a flat period. So this period here originally was a flat area in the first sense, if you remember the forecast here. So the first curve was going that way. And we have been irritated by this up move here, which was not foreseen by this flat curve in the first sense. And then we did an update here based on the cycle analysis, which introduced this upswing here. But however, both projections showed us that we should expect a downturn into end of the year. And we updated the analysis, as you can see here, with the projection that the cycles could move into, and you see it here, could rally until 10th of November, then turning down into end of the year. And it was the same if you observe the cycles we updated on the stock markets, that even on the global indices, we mentioned that in the second half of November, almost all important cycles rolled over to the negative camp. And if you now have an update, what happened to Apple? So the projection was we should see lower lows, or maybe similar low to what we had in Apple here. This is now the analysis just from today. So first, please ignore the composite forecast for a second. So just to zoom in, yeah, you remember the point in time we said on the 11th of November, cycles could roll over to the past. This is exactly here where we are now, and this is more or less the high we have seen here, and then it rolled over. So this is the 11th of November, which you saw here, which was the projection end of October, where we said cycles will go down into end of the year. And isn't that fascinating what you can do with cycle analysis? I mean, we call this projection end of October, yeah, to expect the Apple to top on the 11th November. I think we are close to making a new low. It's not final low, but this was the previous one. We are close to it here. So I think we are close to reaching that low. So it's just, I mean, cycles are not always as exact as this, but this is a prominent example. Go back to the October session, and there have been several reasons why I picked Apple, because as a proxy, there's a lot of volume traded in Apple. The market capitalization of Apple is very large, so it's one of the largest stocks. So you can really use it as a proxy for the sentiment, what's currently happening on the markets. And if you find these kind of proxies where sentiment, where volume comes together, and you find dominant cycles which are continuous and stable, seen in Apple, which I did, I think, August, September, October, you can then rely on your cycle analysis. And now the final reason I wanted to bring it up, it's always important that you pay attention to the near future of whatever projection you do. So this was back in October, the projection we did, where we projected the 10th or 11th of November to see this high here and then moving down into end of December. You should never pay attention to the larger future. So the next and maybe the second turning point. So this period is the important takeaway from this projection. A down move September to December. If we will see an important low here by the end of September, so the second turning point, or even the third turning point of your projection, you should really not see it as a static projection. Just look into the next turning point next to what's the projected direction, because the future turning points could anyhow change based on the principle of variation of cycles. So the phase or the length of these three cycles here above, which have been picked for this projection, might slightly change moving forward. Even if these nominal cycles will stay stable in the markets, their phase and their length will slightly change, which will impact, the more we look into the future, it will impact the timing of this low and the timing of this high. And that said, please have a close look here. The projected cycles at end of October have a length of 79 days, 135 days, 172 days. Now let's roll over to today's analysis. 79, 135, 172. This changed to 81 instead of 79. So the short terms, this is today's analysis, 81, moving back, 81, 79. So very minor change of the length here. The second is 131 days. It was previous 135. And the third one is 172, which exactly stayed the same. So that's the beauty of cycles always here. We really are using the same 3 cycles. So from a nominal model, the same cyclic model as we did at the end of October, while still slightly the length has changed, so might have the phase of these 3 cycles. So now let's pull up this as an overlay. So you see in general, for sure, I mean, same cycles. The past has more even tweaked better, but now looking into the future, and that's the difference here. If you just would have treated the old projection as static projection, we would expect here a low in mid-end December. Yeah. If you update this projection now based on the same 3 cycles, so not a different cyclic model here, the same cyclic model, you see that the low or the projected low has now shifted into January. Yeah. So this topping process here, we should not expect to form a current low now, as we would have assumed from the previous October forecast here. Updated the same 3 cycles. We still see in the top at the 11th of November, but cycles, and this is in the global markets, have now started to roll over, and the downswing should continue into January. So that's the beauty of cycle analysis, and that's what I always try to teach here on this channel. Never use one projection as a static projection. Update the dominant cycles. Have a feeling about the rhythm of each market. So for here, in this example, Apple, you should know which cycle length is the predominant setting, and then you can check if the length and phase has slightly changed, but it's still visible. I mean, if you look at the spectrum, there is this 81, this 133, and that's the 2 lengths. But these 2 cycles here, and even 172, yeah, these are the 3 cycles which would have been picked anyhow from the spectrum. So it's not only staying consistent with past cyclic model, it's also staying consistent to the method and approach we're trying to teach here, to use the peaks in the spectrum. And you even get more confidence once you find the same cycle lengths in the spectrum as you did before, and you see how the past projection worked out. Now you can slightly adjust the projection of this cycle analysis, which is now not projecting the end of the low. It should extend into January, which is not a positive outlook. Yeah, but I need to stop here. That's not the focus for today. So please excuse this sideways look at past projections we did. And I wanted to pick it as live markets are best teacher out there. So therefore, we should often do it. Now, second agenda topic for today on the agenda is long-term cycles for the US dollar index. Second agenda item, long-term cycles US dollar index. Let's use this now. Therefore, we will switch to our cycle analyzer now and analyze first with the US dollar index. Give me a second here. Let's clean it up. Weekly cycles. I always try to convince you or even propose start with a long-term analysis if you move to new or different asset classes here. And in that case, now we are moving to Forex markets. And second, if you move to Forex markets for cycles analysis, there's one important a disclaimer or notice I have to make upfront. Cycle analysis on specific currency pairs don't work very well. So I think that's important upfront. Be careful with applying cycle analysis to individual currency pairs. Yeah, like just analyzing euro versus US dollar, or just analyzing US dollar versus Japanese yen. This, from my personal experience, does not work well related to cycle analysis. Yeah, that's my personal observation using cycle analysis for the past 20 years. Specific currency pairs should be treated with care. I have no scientific explanation for that, but one reason you should be careful with applying cycle analysis to just one currency pair is that these markets are, designed. They are orchestrated by the Federal Reserve Bank of the different countries, different regions with political background. So the currency rate or exchange rate is more or less artificially orchestrated by the interest of countries. So they are not freely floating against each other. So therefore, cycle analysis might not, as we would like cycle analysis to work, because we don't know what political interests are manipulating the currency pairs. At least if you look at one specific cycle pair, and if you look what happens in the world managing the exchange rate of currency, that might be a reason why cycle analysis does not really work well on an individual currency pair. I needed to make this upfront because, be careful, cycle analysis does not work well in the forex markets. Said that upfront. Therefore, the longer term perspective is even more important. My note was specifically to short-term analysis, one currency pair on a daily or even shorter time frames. So we could use longer periods, like using weekly data sets, and therefore the US dollar, it's not just one currency pair. I think the US dollar is measuring against 6 individual regions or currencies. So therefore, starting with the US dollar index, long-term view, is a good starting point, because you avoid the individual forex pair on a short-term perspective. Okay, so said that upfront, what we're doing here is a weekly series on the US dollar index, right? So going back into the year of 2000 or even more history from this larger all-time high here, moving into today's situation where we had the end of this parabolic up move here and the strong down move here into this area. So we have a total of over 1,000 data points, which is good. Maybe even a little bit more than we really need, but it's a good offset or a good starting point, having around 1,000 data points. You know, I always like this kind of offset between 800, 900 data points. That's okay. And weekly data, long-term series. So that's the starting point, right? So let's now have a first look into the spectrum. So we have a lot of peaks here in the shorter area, and the ones now looking interesting, or the most important peak here. And I think, to be honest, even if you don't know anything about cycle analysis, if you're doing this the first time, that's the most important peak, which stands out in the spectrum here, even if you don't know anything. I mean, the starting point is go to the spectrum, which is the one here down below. That's the result of the cycle analysis on this data set here. And the peaks show us on the x-axis where is the length of the most important cycles here. And the peak in the spectrum give us the exact length, which is in this case 183 weeks, which, by the way, is an important long-term cycle in the equity markets in general. But anyhow, but seems to have a relation here, a different phase, but similar relation, 183 weeks. So our criteria are we want to have a clear peak. And it separates to the left and to the right. So it's really moving down on the right. It's moving down on the left. We have a green triangle, which means we have a high Bartels score. and the triangle is large, so the strength score is also high. So this is the go-to cycle for us all. That's the starting point. There's no individual interpretation here, yeah? So you could also do it in a mechanical way. So, and it's the same cycle is also listed here in the table, yeah, as the second most dominant cycle here, 183 weeks. You see the strength score very high and the Bartle score very high, and you could skip the one listed on top because the Bartle score is too low. This is therefore a clear reason not to use this cycle here. So, said that, let's use this cycle as the dominant cycle to start our dominant cycle analysis. First here, let's have a larger look at how this cycle plays out. Then the second step is always, if you're new to this channel and how it works, just make a quick visual inspection about how the alignment of past bottoms and tops is related to the changes in trend in the US dollar index. As you know, this cycle is not used to project absolute price movements to the upside or downside. This is a timing tool. So here, this low is aligned somewhere. It's here, and then an up move into that point here, while we have then the low assigned here based on this cycle. So downwards move here. Then we have the top here aligned at this timing projection here, which is good, an upswing here. Then the timing of the low is somewhere here, so not exactly on the low, but you see from the projection we moved into this low, and then the top projection here is aligned with this one. Then an upswing cycle here into this area, then the next low has projected here, then the top is somewhere here, based here. So you can make this the swing, we are connecting or checking the visual correlation of the most important swings with this timing situation, which is very nice, or very high correlation of the swings. So just trading the swings with the alignment of past important lows in relation to the projected tops and bottoms of this cycle here. Right? I think it clearly should become visible now. And you see that it's not about projecting the exact short-term top or bottom. So that's why you should not trade cycles on its own. But you see that the changes in trend, in general, if you just use the trend or the underlying changes in trend, that the cycles really did a great job of projecting the important periods of time where the trend is expected to change. And I think that's where we use cycles for, not for trading exact price projections, tops or bottoms, but the timing, in relation to making changes in trend. And this cycle, if you just connect the major lows and bottoms in the US dollar index, as you can see, for the past 20 years, is really working well. So, I mean, it's not surprising that it showed up in our cycle analysis spectrum as most dominant cycle. But however, sometimes you don't see this nice correlation. So therefore, this cycle can really be used from a long-term perspective. So zooming in a little bit closer here again gives us then the projection long term. I mean, short term, we don't know how to treat the short term movements here during this peak, but we are at peaking projection, and maybe the peak has already happened here back in October. More important now is the long term projection. So the change in trend we see here in the US dollar should be very important moving into for the next 2 years. So for the next 2 years, I think we are at an important point where the past trend now changed. So from 2021, into end of 2020, we had the upswing into the end of 2022. So 2 years of US dollar upswing against the other 6 currencies. It looks like this trend is coming or has come in the past 2 months to an end. So the long-term outlook for the US dollar is not positive. And now I would be careful going to the shorter term projection as explained earlier. So instead of switching now to a shorter time frame, I would use individual currency pairs to see if you can view confirmation or disconfirmation. What we need is kind of confirmation. So for example, and that's what I like as I'm based in Germany, Europe, instead of looking at the US dollar, I'm interested in the euro. So therefore, I'm more than looking into the euro versus the US dollar, which I would never do just one currency pair. So I explained why. But in relation to the US dollar index projection, let's see now what the euro versus US dollar currency pair specifically would tell us. Would it be in alignment or would it be in disalignment? I don't know. So therefore, let's switch now to the euro versus US dollar here. I'm using just the standard setting. So opening here the euro chart against the US dollar. That's how it would start, just in the standard setting, using the past, let's 3 years, 850. So we can change it in a second to see if there's a difference. Let's have a look at our spectrum here. And what we clearly see is that we have the cycle here. So what stands out in the spectrum? The cycle here with 176 weeks. So just looking at the length and the peak here, it's okay. There is also the shorter one here with 82. But the reason I'm looking at this one here is that 176 weeks with a clear peak in the spectrum is the same nominal cycle as 182 weeks, which we've seen in the US dollar index, right? So we identified the same cycle length here as key peak in the spectrum as we had in the US dollar index. However, for sure, I would not expect the same phase as we are now analyzing the euro versus the US dollar, and not the other way around. So let's activate this cycle and see what this long-term projection tells us. And again, same procedure here. So let's check the past turning points. I will do it a little bit quicker than before, not to waste your time here. So we have the top moving into this bottom here. That way, here's the top, here's then the bottoming area. This way, that way, zack, 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 here, boom, here we go. So you see past alignment. I mean, you could also use the correlation score, but now from the outlook, and that's interesting here if you want to compare the both of these predictions here. So it's in alignment. Yeah, the short message is we have an upswing projection for the US dollar now. So the euro, where it has been in a long-term downwards swing here since late 2020, or even the start of 2020, as we said, into the end of 2022, this cycle now changed its phase into an upswing projection into early 2024. And now comes the difference between both, if you now switch forth and back between both. So you see here the upswing from the projection here has already started in August. Yeah, so the bottom of this projected cycle has happened back in August, and the euro is already in its upswing pattern into early 2024, so for the full next year. Compared to the dollar index, where we just said maybe the cycle top is due early next year. That's the difference compared to the euro versus US dollar. So this is the US dollar index. It looks like the top might just come, be ahead of us, and then the long term looking into end of 2024 said 183 weeks, and the top is in the future. So we don't have a final agreement here on this projection, but the timing projection between now and February 2024 is the same. So at least 2023 and latest February 2023, I think when we reach this March. So from March 2023 into end 2023 or early 2024, both cycles are in agreement. So we have a negative outlook for the US dollar, February, March next year from the US dollar index, confirmed by the euro US dollar, and a positive outlook for the euro versus the US dollar, at least an agreement between February, March next year into early 2024. That's the long-term perspective, and they both confirm each other, even if they have slightly different exact weekly cycles, but from a nominal point of view, the same. And you see the phase is also in alignment, giving us this range, which gives you more confidence to using the cycles for analysis. So just for the fun part, we could also, I'm also like to see the stability of the cycle analysis if we change the input parameters. Yeah, so that gives you kind of confidence how stable your model is. So, and in order to do this, let's also add some more historical data to the analysis, as you see here in light blue. But however, this data has not been used, and you know that from the US dollar index, we used a little bit of more input data. So let's do the same here for the euro versus US dollar. So I will just move the start of the analysis more into the past. Yeah, just setting the start point here and updating the cycle analysis in the spectrum. So now we have just used a little bit more data for the euro versus the US dollar. So you now see that we have also now used above 1,000 weekly data points, extending our analysis more into the past here. And let's see now the spectrum. So the peak in the spectrum is the same peak. And this is what I want to see, or to cross-validate with changing the input parameter of the cycle analysis. So you see now even this peak has become more visible in the spectrum. So it's even stronger if you add more historical data compared to this one here. So it's clear obvious that even if we add a little bit more data to the analysis, this peak becomes more visible, and it's exactly the same length, 176 weeks. So we changed the input parameter of the analysis. We received the same cycle length here. And from the phasing, it's also the same. So you don't mind, I've not preset here the input or output to show you something. I've just changed it on the fly. I didn't know what will change here. But that's what I also recommend. Try to change the input parameters for the cycle analysis, for example, the start point of your analysis, and see if the output, so the spectrum and the key cycles which stand out in the spectrum, still stay the same. If they flip around, this could also be the case. You just slightly vary the input parameter and you receive a completely different output. Then you just cannot trust it. Yeah, you can throw it away. But in that case, what I showed you, I added, 3 years more of data, 200 more data points, which is at least 10-20% more data, more input, same output cycle lengths. So that's good. It's good. It's a stable cycle. So yeah, that's it for the US dollar Forex update. As I said, my experience with now moving to the daily time frame on Forex pairs is not useful. I gave you my explanation. They are orchestrated markets, so then on the daily time frame you have to be careful. However, the longer cycles can't be overruled by I don't want to use the word manipulation, but let's see what happens during the in these Forex markets. Yeah, that's it for today's session. I will now take attention or take some time to pay attention to your questions. So let's check with the I will check your questions now in the chat section. So you can also take the time to add more questions if you like. There have been some questions related to to crypto. I receive often these kind of questions. I just want to recommend your attention to the session we did last week, Monday. There I did a longer term review on Bitcoin crypto, and I really exactly tried to answer this question here. So, and you will find the answer in last week's Monday session. So please take your time and review this. Maybe, yeah, back to the Apple update I did. I mean, it was not a new analysis, but just the update. Apple is not the S&P. It's I use it more as a proxy from the tech area. So, and I think it's more, even though it might be not in the Nasdaq, but Apple is more used as a proxy for the tech, not for the broader market. And you could also see what happens. So during these times, I see that the tech, which are often leading the global markets and have a more are the early cycles which you see to start to roll over, which is why in the tech sector we didn't have this strong rally as we had in the Dow, so not in the tech area, and why this projection also worked out more early. So as a leading indicator in Apple, the S&P cycles, which we have a lot of more cycles. I also did an update at the end of October session. So there have been more cycles than these clean 3 cycles composite in the global markets. And there we needed to wait until end of November until all of these cycles in the broader S&P 500 markets also started to turn over. This is why we saw the lag of the cycles of the broader market for the S&P to roll over. We needed to wait until December, which happened, I think, these days, last week. Yeah, 2 weeks ago, we saw then the cycles have been in alignment. But we needed to wait longer than in the tech area. And that's actually why we saw Apple maybe sideways, but at least, I think, 10th or 11th of November was the final high and then going down. While in the broader market, we had some other cycles on top of that. But, David, it's just a short try to this topic. Apple's Dow gold ratio might be interesting. So instead of comparing the Dow in as priced in US dollar, we should use a Dow chart priced in gold. Interesting idea. I will take this to one of the further sessions. Thanks for wrapping that up. It's the most important question out there. So looking at cycles, but don't tell you anything new here. Using cycle analysis, dynamic cycles, not using seasonal cyclic models, because you all know that from a seasonal cyclic perspective, we are in a very positive prediction. The dynamic time cycles don't project the rally. Instead, they project the opposite. But this is what I showed you end of October. I just said we need to wait until mid-November, until all cycles roll over, and then it will kill the year-end Santa Claus rally. So at least nothing new. And that's why we don't need to update every day. I think now it plays out what we have seen back in late October. We see this now happening in the markets. So cycles say, dynamic time cycles say no. Okay, video quality seems to be different on different ends, but that's okay. Other questions are related to some charts. Yeah, I don't use the euro index. That's right. Maybe a good idea. I use the euro versus the US dollar just to cross-validate the US dollar index. I think euro index is a good idea, but I would leave it up to you and the community to check that. I'm not finally sure about the ID to get this up, but you're right. Should be seen as a confirmation. If you reveal the same cycles, so only then it's a confirmation. Yeah, and Stephen, that's the point. I mean, you have the political arguments for that the euro might be moving up and the dollar might be going down. But exactly that's the problem I see on a daily basis, that we have so much political conflicts or framework conditions which are played out, which are influencing and which are not free floating. They are orchestrated by our political instances, by federal banks, which we have in Europe, in the UK, and in each country. And they, based on these political situations, they try to influence the price, which is always different and not easy if you apply cycle analysis. But what you explain here is maybe supporting the analysis we did here. So Stephen, thanks for bringing this to view to our attention. Okay, connection problems. I don't see any issues here on my end. So rendering network, all fine on my end, and at least everything is green here. If there are issues, I would be sorry for that, and I hope at least the video recording then don't have any issues here. Said that, I think we are moving into a seasonal, very important cycle. At least for me, we are approaching Christmas on the weekend. It's always a time where we should relax, set back, just analyze what we did, take some lessons learned before all the stress of the next year comes into our attention again. So I want to wish everyone happy Christmas for this year and the days to come. I will still continue the weekly series here. So if you want, between Christmas and New Year, I will be here next Monday to analyze a little bit market cycles, to learn something out of it. Otherwise, please take your time to enjoy Christmas period. I wish you all the best. And we will re-meet, if you want, next Monday, same place, same time. Thanks for joining. Have a nice week. Bye.